and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'll be your host for the next 25. Well, I actually will probably be pushing 30 minutes today on Options Guide TV. And before I get going, we got a lot of fun to talk about. We had a couple of trades that have worked out that we just put on Monday. But if you have any questions, please do put them in the chat box if you are in the Tradier YouTube channel. Or if you are inside the Tradier Hub, hub.tradier.com. If you don't have a sign-on, please make one. And once you log in, you can ask questions via the Hub. And then lastly, you can also do this through the x.com platform. I know you can ask questions, not exactly sure how, but we do stream live via my handle, which is at Brian Overby, and also the Tradier x.com profile. Okay, so this week we decided, we got a big week for the markets, right? We got an earning. We have a huge election that is coming. We have all the big 7 stocks announcing earnings this week. Google is the main one that is kicking it off. But then on Thursday, we have Apple, we have Amazon, we have Microsoft in the mix. That's actually happening today. And so just the comments around AI and everything that goes along with that in the marketplace. And then we finally get into November. And in November, I want to get a little bit longer on the markets. But we did take a shot this week with an SPX trade. And that has turned out to be okay. We're getting into November. I'm a little bit okay with starting to get bullish in one of my portfolios that I have had some cash sitting around. I'm going to start buying. It's a retirement account. I'm going to buy a little bit of the major indexes, a couple 100,000 worth, just to get set going into the November season. And as we go into the Christmas holiday, go into the holidays, end of the year, Thanksgiving, Black Friday, just a lot going on this time of year, especially because of the known event, which is the presidential election at the beginning of November. Okay, so let's run, I guess, right now. Let's see where we're at. Let's go to the Tradier Pro software. I have Amazon. Oh, I started with Google. So Google was very nice to us. As a matter of fact, this little breakout right here in Google could be a very positive thing for that underlying stock. Now, Google has had strong fundamentals. It is the best price as far as a PE is concerned compared to the rest of the Mag 7 stocks. Trades at about 24 times earnings. And it's struggled here. And you can look in the chart. You can see let's zoom in this little area from right here on over. You can just see that it's just kind of struggled to break out to the upside. But right now it's peeking its head up out of its hole, wondering if there's going to be, 6 more weeks for Christmas. And we see that this earnings report has really helped the underlying stock maybe break out to the upside. I like what we're seeing here on the chart. And we got bullish on Google, mainly because I think of a valuation scenario. I said this week on Monday that out of the Mag 7, the one that I find the most interesting is Amazon. And I'm not always just trading earnings inside the portfolio. These are just the hot here and now topics for our videos. This is what the customers demand. So we always try to look at some earnings trade. Talked also on Monday's show about if I was looking at Apple. Apple more so is a protection strategy around earnings. So that doesn't mean that you think it's going to go up, but almost everybody has shares of stock inside their portfolio. So if I'm looking at Apple, a lot of times I talk about a protection strategy, something like a bear put spread, or just buy a put outright, or sell a call against Apple. This week, we're going to look at Amazon. They're going to announce Thursday after the close. And I always like Amazon always does announce on it. Well, I shouldn't say always, because as soon as I do, they'll change it up. But for years and years and years, Amazon usually announce announces on a Thursday, which means you have 1 day for the option contracts to live, which always makes it interesting when you have a higher price stock. It was really interesting when it was $1,000 stock, but you have a higher price stock that has high implied volatility because of the known event, the earnings announcement, and it has 1 day to live with those option contracts. That everybody likes the 0 DTE and the SPX and a lot of the ETFs. Well, this is a 0 DTE scenario where they announce on a Thursday and the Friday option contracts live for 1 day. So all that juice, all that time premium, everything has to come out, and it all becomes about the price and getting the forecast correct. And I just like that. Now, you can obviously, if you're not as confident, you can go out a little further in time and you don't get that benefit of that being a 1 day option contract. But also, if you're wrong, you're going to pay for it. And that's the good and the bad of short-term option contracts and basically gamma. That's what you're trading whenever you're trading those very short-term option contracts. And I should mention, if you go to the Meet the Greet section of the options playbook, I actually just put out 2 videos, 2 nice videos, well-edited videos on Delta and on Gamma. They're both about 10 minutes long. All you got to go to is the Meet the Greet section inside my website, theoptionsplaybook.com. Okay. Google 178 up $8 at this point in time. Let's go and look at our trade. So we did the expected move. Then the expected move was right around $11. Now we did this on a Monday, and usually I do say this: if we're doing it on a Monday and they're announcing on a Tuesday or a Wednesday, I would wait to that day and use the same principles to set up the trade. But we always, we tape our show when we tape our show, and we use the real-time quotes at that point in time. So this is going to happen with Amazon. Amazon's going to announce on Thursday. So we're taping the show today. Wouldn't mind taking the same concepts that we're going to talk about on the Amazon trade and applying it tomorrow. But we always ride with the numbers that we had when we do the show. So in Google, with an 8-point move at this point in time, this isn't a 0 DTE option, and that does matter to me. And it affects the strategy that I will choose. I'm probably not going to do a butterfly in Google with a short term. I have before, but the fact that they announced in the beginning of the week as opposed to the end of the week definitely affects the strategy. But our outlook was, and let me grab the screen grab that we had from this week. 1 second. Our outlook was that we're going to stay within our expected move, and we're going to do a trade that is bullish on Google that will limit our risk by doing a long call spread. And then in that spread, we are hoping that we're going to use what the marketplace tells us and not try to go beyond a certain level. So the marketplace was implying a move of around $11. The stock was at 165.72. Now it's at 178.41. Now, the expected move would have changed, mainly because there would have been one more day to pass before Google announced earnings. And here's where we're at. So here, let's set up our trade. Our trade was, we were buying the 170 call, selling the 175 call with the shortest term expiration. So we bought this option contract on November 1st. Yep, November 1st over here. And we sold this option contract. All right, so $4.43 is where we are at. We are $3.30 above our current strike of 175. And this last 50 cents is going to be hard to extract. And it usually is. If you see this, if we're doing this long call spread, implied volatility has came in, and I guess it is trading close to its norm. I thought historical vol was down around the 28 or 30%, but it's saying it's around 35. So IV is actually a little bit below what the historical is at. So I don't expect much more of a volatility crunch to help us out, if you will, because if we want to get that maximum on this spread, it's 5 points wide and it's $4.43 at the midpoint right now. What we need is this option contract to go away. And you see, we're close enough to the money that this is still trading for $4. As far as intrinsic value, we got 80 cents left in it, I should say. Intrinsic value mean the time value is much more important than the total cost. So we have 80 cents. So we need this 80 cents to go away in order for us to receive the maximum on this trade. It's that simple. We want this option contract is going to be representative of the intrinsic and extrinsic value, but we still got to pay something to close this out as far as time premium is concerned. So until this 80 cents starts decaying, which is going to happen overnight pretty quickly because we are on Wednesday, from Wednesday to Thursday, this might get cut in half. Actually, you might go down to, if it just stays where it's at, but now you've got that risk because you're trading right at this level. So I personally would probably put this in for $4.50. And if I got filled on that, I would be happy and give up that 50 cents. We paid $1.60 for it, rounding off. It was $1.59 according to my screenshot. But let's say we paid $1.60 for the trade. So we got plenty of upside on it. I would definitely close it out if it got to $4.80. That would be my goal. Never try to extract that last 20 cents. Like I said, it's just not worth the risk to try to do it. Might be worth it today to try to do it with the momentum to the upside and it trading. And one, Wednesday to a Thursday is a huge, as far as, let's get rid of the theoreticals, right? And talk about the real world. In the theoretical, the pricing models start to break down when you start to lose time premium. When time premium starts going away, the models just don't work as well. And so as far as real world trading, I always feel like Wednesday to Thursday on higher price stocks like Google, I still think it's a higher price stock, even though it's done the split. That's when you really get a lot of time decay. And then from Thursday to Friday, you get the max. And then obviously from noon on Friday until the close Friday afternoon, then it's like, wham, my sled hit the tree. All that time premium has to go away. So in this instance, you could stick around. Now, if I had a 5 lot on or a 10 lot on, I'm going to close out some of them for sure. We always talk about a 1 lot to try to keep things as simple as I can on Options Guy TV. So if I'm trading this 1 lot, I'm getting close to that 450. We're at noon on a Wednesday. I don't know if I'd want to take the overnight risk. We got Microsoft announcing tonight and just a plethora of different earnings. If I can get out at 450 on this trade, that's where I'm going to go and I'm going to get out. Because any news in this space from any of the Meta, what other stocks? Gosh, we got just so many of the mega cap tech stocks that are announcing. I don't think it's worth the overnight risk. That simple. All right, time to move on. Talked way too much about that. So SPX. So we decided kind of flippantly at the end of the show last week that we were going to get long an SPX option contract. Now, I plan to do this a lot more in November, where on a Monday we'll buy a long call spread. Depending on how you feel for the marketplace, maybe we'll do a bearish trade. But in general, this is kind of my go-to. On the November 1st expiration, we came in and we looked at selling the most at the money option contract, and we did a fairly expensive one. I don't mind if you're doing 20 points wide, if you're doing 10 points wide, 15 points wide, I'm okay with it. It's all about the risk and how much you're willing to put up on your initial trade. I do have an adjustment that I would do on the SPX trade. If we got to the Wednesday, just if following show protocols, if we got to Wednesday and we had to adjust, I would roll this into a butterfly. I would sell a short spread, bring in a net credit, and then you have a chip in a chair. Very, very simple way to say that. Okay. But in this scenario, 58.15 selling, we did the 58.35 and we're at 58.37. Okay, so we came down a little bit. We were up a little bit more during the day today. Okay, so let's see where we're at. 15.35. And this will show, this is actually a good scenario in that we came down a little bit off of the highs of the day. That should be a buy. And we bought the November 1st expiration, 2 days away. D8.15 and 35. Okay, so we're up a few cents on the trade, but we're almost back to where we were. 58.37 is where the market is. And when we did this, we were at 58.33. We did this for a net debit of $12 to the account, and it's a 20-point wide spread. So this is when the time decay happens. It's tonight. We're up 40 cents on the trade. If we fill at that midpoint, it's been dancing around between 40 and 50 cents. On this trade, I definitely going to stay the course because tonight is when the big time decay happens in this position. So we bought 58.15, 58.35. Let's go see what happened in the SPX chart on Tuesday. I wasn't watching this one that closely. Oh, and I was highlighting the wedge pattern in the, we're still trading, like we're kind of busting down a little bit on the wedge on the downside here. Looks like we're right on the lower end of that position. And that's right. So this is the reason why we did this. We thought maybe it might bounce and come back within the range of this wedge pattern. But if we do get a breakout below here, that would definitely be bearish. And I still think that the market's going to stay in this kind of neutral phase until we get through the election. But yeah, not a ton happened here. 58.33. We just didn't have much going on and just kind of staying the course. So not much happened yesterday. This is where we're at. I'd stay the course tonight. There's no reason to panic. There's no reason to take a 50-cent gain on this position. We'll let this run and we'll come back on Friday and we'll look at it and see where we're at. And we'll have one more day to trade this. Yet tomorrow, if the market did move down, and let's say the market moved down a 0.25%, and it would be down around this strike price, well, then I would think about rolling it into the butterfly. But ideally, we're going to go up 20 points as opposed to go down 20 points. That's ultimately what we would like. And we were up a little bit today. At one point in time, we're trading north of 58.40. So stay the course. Okay. Now, Amazon. Any questions, by the way? And let me double check. Make sure if we got any questions going on. And if not, let's get into Amazon and let's look at an Amazon trade. Okay, so here's showing you the implied volatility, right? This is the nearest term expiration. Amazon is announcing after the close on Thursday. And also Apple is announcing after the close on Thursday. So with the stock at 193.79, I want to get more bullish on Amazon. So I'm going to look at one or two trades. Now, I don't mind doing the same type of thing that we did in Google. And obviously, you know, we almost got the maximum in Google. I still would close it today and leave a little bit of money on the table and not take that risk. But right now, if we click on the ask, if we're doing our due diligence and understanding what the expected move is, we got pretty close, right? I think it was 11 and some change in Google, and now it's showing us a midpoint of $12.75 if we buy the most at the money call and the most at the money put. So on 195 plus 12.75, that would leave us at 207.75. So 207.50 would be the highest strike that we would want to sell. And then 210 is what it's saying is close to the one standard deviation move. So I'd probably do the 200 to the 205, staying within the expected move. And that shouldn't be too expensive. We got a little bit less time premium in it because we only got 2 more days for this to live. You got all day, half a day today, Wednesday, all day Thursday, and then all day Friday. So 2.5 days would be a better way to say it. And then they're announcing obviously after the close. So this would be my first paper trade. And then I'm going to do something a little bit creative on this. All right. So let's buy this. No, I screwed that up. Here we go. We said we want to stay within the expected move like we talked about on Monday's show. And we just want to be bullish on this underlying. We're going to buy this. We're going to sell that. So here's my aspect on Amazon. Amazon is a little bit pricier than Google, but in the AI space, they have a project. I think it's called Amelia, where they've tossed a lot of money into making an AI product that will help you find out what you should buy on their site, right? Basically giving you suggestions on what you need that you don't think you need. And they're spending a lot of time on it. So I expect any type of news in that front, because that has driven a lot of these stocks higher, even though they are at fairly high valuations. So I don't mind trading Amazon as an AI play. And also you have the web services. So there's a lot of benefactors here for the Amazon. And I think, Apple has been in the news a lot more than Amazon has been because of their recent release and the fact of the Apple Intelligence and everything that's around it. And I think if Amazon comes out and talks a little bit more about their AI and has a decent quarter, we're going into the holiday season, that we might get a little pop on earnings. There's always a buy the rumor, sell the news scenario. So with earnings, you never know. I am just a little bit more bullish on it. And if I manage my risk by doing a long call spread, I don't mind doing this trade. And here we go. We're very close to where we were on the Google trade. So I'm going to send this to the what if calculator so that I can grab a screen grab of this at the end of the show. But we're looking at 5 points wide, and we're staying within the expected move. Did that again. I'll leave it there. We're within the expected move. We're at 161. Let's make the math simple. Let's call it 160. I do think we can get filled very close to that, mainly because of earnings and the obviously huge open interest, huge volume in these option contracts. So you take 5 minus 160 and you come up with $3.40. So we're risking 160 with the potential to make 340. And here's the difference: is this has 1 day to live. So in the Google trade, you got a few days. You got to decide if you're going to take the trade off or not. In Amazon, if we bump up above the 205 and we're there by noon, you're going to get close to the maximum. There's just 1 day to live. And this premium right now is $2. If you are correct on your forecast, you need all the time value to go away, the extrinsic value of the $2, in order for this to max out. And that happens closer to the expiration date. So this is a one or done. Either we lose $1.60 or hopefully we make 340. And that's what you got to be prepared to do, because you're not going to salvage anything on this trade. So 100% speculation. This would be one way that I would approach it. Now, if I want to try for a little bit more on this trade, I might think about doing a modified butterfly. So here's how we're going to do the modified butterfly. We're going to give ourselves a little bit more upside, and I'm more apt to do this on Amazon because it's got 1 day to live. If I do think it can get to the 200 level, we will buy this and we'll sell 2 of the 210s, and that's going to give us 10 points. That's a 10-point wide spread. And then if we go up to the upside, this is 10 points. We're going to only go 5 points here. And we're going to buy this option contract. Okay. So no, we sold this one. Sell, and this one's a buy. Okay, 161. And then we got to go out and buy our protection. And we can go 2.5. Yeah, we can do that. So let's save 16 cents. Okay, and we'll do that. And then that still makes us profitable if it blows us out the door. Yeah, we'll do that. All right. Here's the difference. This is a modified butterfly. We're paying $2. So in our other trade, we were paying 160 with the potential to make 340. Here is the modified butterfly. Here is the alternative. We'll send this to the what if calculator and scroll down, and hopefully I don't click on it and screw it up again. And here's what we have going on now. So from 200 to 210, which it only has 1 day to live, even more applies because we have to buy 2 of the 210 option contracts back. We have to buy 2 of the 210 option contracts back. These are the short option contracts. We would have to buy to close those positions. We buy the 200, but that means that if it does go to 210, we have 10 points of upside. The maximum this could trade for is $1,000. Now, if it keeps going on up anywhere from here to there, well, we make a little less than 1,000, but anywhere within this range, we're good. If it blows out the door and it goes all the way up here, we stopped short on our short spread. We stopped at 217.50, which gives us $2.50 difference between the long spread, where we buy the 200, sell the 210, and the short spread, where we sell the 210 and buy the 217.50. So because of that, that means from this point on out, this butterfly should trade for $2.50, the difference between the two. We paid $1.94, it looks like. Well, now it's saying $1.90. Let's go $1.90. I like that number. We pay $1.90 for this trade, and we can get 250 if it blows the numbers away and does a 2 standard deviation move. We would still be up 60 cents on the trade. Now, still have the same downside risk. There's nothing you can do. If the forecast is incorrect, the market goes down, we're limiting our risk to $1.90 or $190 for every 1 by 2 by 1 butterfly that we put on. If we put on 5 butterflies, you would times that number by 500, and that would be your max risk. And that's the way we would approach the trade. So I'll screenshot both of these. It's really about risk. I like the modified butterfly a little bit better because it gives myself a little bit more upside. The fact that we can keep the cost close to our long call spread is because we're selling 2 of the 210. 2 of the 2, and there's still some premium there, right? So the 210 option contract is still trading for $1, not too shabby. And we're capturing that premium. And oh, by the way, that's right at a 1 standard deviation move, 210. It says the delta over here is 14.5. 1 standard deviation move would mean the delta would be right around 60. So that happens about 16% of the time. And even with the implied volatility that still applies, the fact that IV is 105 on the November option contracts, and historically it's around 40. All right. What a show. A little bit long. No comments, no questions. All right. Kind of, I guess you guys are really I must be explaining the stuff extremely well. Interested to see what happens with Amazon. Just a great week. It will be fun. I like the fact that we started off with a couple of winners. Well, I use that term lightly. Oh, cut. There we go. Now we're moving back up a little bit. 58.43. That's nice. That's a nice move up. That really affects our strategy here and makes me. Oh, I don't have it in there, do I? Shame on me. I just got the long call vertical, but I don't have the SPX in there. That's it. let's go ahead and move out. That's it for this edition of Options Guide TV. Thanks for coming. Excited for Friday. Excited to get into November. I have to admit, I think everybody has a little bit of election exhaustion. Just to get rid of the ads off of the TV after November 5th would be a great benefit to all. Thanks for stopping in, and I'll see you this Friday on Options Guide TV. Don't forget to set up your profile inside hub.tradier.com, and we'll see you then.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.